Hi guys, and I'm back with another class. I'm back again, and I want to talk about some concepts here. So guys, as you see on my chart, we have some some graphs. We have some graphs here, and the first graph on the top is a candlestick chart graph. Is a candlestick chart graph. Then the graph below the candlestick chart is a graph that is simply showing me the the price movement of uh, of these assets that we are we are trading, right? So let me start by explaining here a very simple concept. I want us to talk about uh, to talk about leverage. And as you all know, I had created a video that was explaining things to do with leverage. Leverage simply, leverage simply is what is is the money that you are being given by the broker to do what to trade with so that you can make profits. Then you return their money back, right? For people who don't understand leverage very well, let me come with this analogy of a bank and a borrower, right? Let me come up with this analogy for a bank and a borrower. So suppose you are an investor. Suppose you are an investor, and you don't have enough capital to do business. You don't have enough capital to do business. What you'll do, you will talk to the you will talk with the banks. Then they you will talk with the banks so that they can lend you money so that you can do you can run your business. So what normally happens with the bank, first of all, before they give you a loan, they must evaluate your credits. They must evaluate your credit scores. So, as they evaluate your credit scores, you have to know if you qualify for some certain amount of capital that you are borrowing from them. So the evaluation will work in a way that favors your credit score. So let's say you want like 1,000 USD or 100,000 USD. What you will do, you will talk to them. Then they give you some condition that maybe you deposit 10% of that $100,000. You deposit that $100,000 at the 10% of $100,000. So if you deposit that 10%, they'll give you that $100,000. So that is the principle that works with the banks, right? So you have to do a business with that money, that 100,000. Then they'll specify a time that you'll have to do it to pay back that money, right? Maybe it can be 3 years or 4 years. So that is how the banks works. But when you come to the trading market like forex market, what normally happen is that you will talk to the broker. You talk to the broker, then the broker gives you some money. The broker will give you a loan, and that loan is called leverage. So before the broker gives you that money called leverage, you'll have to do some initial deposit. You deposit some amount in your trading account. Let's say you have a deposit of $200. So that deposit of $200 will qualify you to access the brokers leverage, or the brokers loan that give. Then we have some terms and conditions that you'll have to follow for you to do it, to trade with that leverage that they have given you, or that money that the brokers have given you. What will normally happen is that the system has been set in a way that when you're trading a unit of 200 units, what you will do, your account will be set in a way that if you are in a drawdown, if you're in a drawdown, or let's say 10% or 50%, the broker will automatically deduct that drawdown of 10% from your initial deposit, right? The system has been said that your drawdown will be deducted from your what? From your initial deposit. So let's say you have a drawdown or you have a loss of 10% in that trade. The broker will do what? The broker will deduct only 10% or only 10% from your initial deposit, which is $200, will be deducted, right? I think I'm explaining this concept in a way that is getting, in a way that you are getting what I'm trying to explain. If you have an issue with the leverage or any issue to do with the brokers, I'll do some other tutorials and explain more about how the brokers work. So suppose you make a profit of 20% from that trade. That 20%, the broker will not touch that money, or the system will not deduct anything from that money. That 20% will be the money that will be added to your initial deposit. But if you make a loss of 20% in that trade, the system will deduct 20% from your initial deposit. So in a trading market, like even in the crypto futures indices, or even in forex, what normal happens is that you have to purchase some amount of units for you to hold that trade. Maybe let's say the minimum amount of units you can trade in most brokers account is around 10,000, is around 1,000 units. Is around 1,000 units. So these 1,000 units, they're enabling you to hold that trade. Those 1,000 units are enabling you to hold that trade. So 1,000 units is the minimum, or 100 or $1,000. So what will happen is that please post your questions in the comment sections. So what will happen is that you will have to what will happen is that your brokers will do what? Will give you that 20%. So the market will only allow to get the profit that you have earned. The profit that you have earned. Guys, sorry for some interruption in the background, but let us please move on. Sorry for interruptions in the background. So what will happen is that what was I explaining? I was explaining things to do with how brokers operate, and you'll have to purchase at least a minimum of 1,000 units for you to hold that trade, right? You'll have to purchase at least a minimum of 1,000 units for you to hold a trade. So let's say you are trading this market, which is Ethereum versus US dollar. For you to buy or sell, to buy or sell any units in this market, you must have at least an account size of what? An account size of $1,000. So in most cases, you'll find that most of the people can't afford to have what? To have $1,000. They have very small amount of money, but the broker can lend them some money so that they can purchase their units, right? So if you borrow from a broker 1,000 units, this means that the broker will give you $1,000, and that $1,000 means that you are doing what? You are holding a unit of $1,000. So your leverage will look like this. Your leverage will be 10 to 1, right? Your leverage will be 10 to 1. If you borrow a broker, let's say $50,000, if you borrow a broker $50,000, your leverage will be one to what? 1 to 50 leverage, right? If you borrow, let's say $100, $100,000, your leverage will be 1 to 100, right? Suppose you borrow, let's say $2,000, $200,000, $200,000. Your leverage will be 2,000 to 1 to 1 2,000 to 1, right? Your leverage will be 2,000 to 1. I think you understand those ratios when I say 2,000 to 1. So I need your questions in the comment section so that I can understand if you are also understanding. So a leverage of 50 to 1 means that in any trade that you are holding, or in any trade that you are depositing $1, your broker is giving you $50, right? In any trade that you are depositing $1, your broker is giving you $50. And in a leverage of 2,000 to 1, it means that in any trade that you are buying or selling, the broker is giving you 2,000. Is giving you how many? $2,000 in a dollar that you are depositing. So also it also depends with the lot size that you are holding, or the position size. I'll also explain the position sizes. So if you are having a trade of let's say a trade of 0.01 lot size, a trade of 0.01, this means that you are holding a trade which is having 1,000 units, right? You are holding a trade which has 1,000 units. So in this trade that you are holding 1,000 units, what will happen is that you'll have to divide that 1,000 by 1,000, right? You'll have to divide that 1,000 by 1,000. If you have a leverage of let's say 1:50, and you're holding a trade of a trade of 1,000 units, so you just take 50 divide by 1,000. The figure that you get there, that is the margin that you are having, right? That is your margin. I think in the previous videos I explained things to do with the margins. And when I talk about the margins, let me try to do the recap of the margins and the free margins and other stuffs like margin levels and the margin levels, free margins and the margin levels. So guys, you can see from this tab, or from this screen, you can see here balance, equity, free margin. So balance is your initial deposit, right? Balance is your initial deposit. I'm using this video for education purpose, not for trading purpose. That's why I'm using an account that has no funds. So your equity will be your balance plus or minus the profits that are running in your account. Then your free margin is the money that you are remaining with when you take your equity, then you subtract. Yeah, right. When you take your equity, you subtract it from your balance. That is when you get your your free margin. You get your free margin. So you have some other things called margin level, but let us continue with this concept of leverage so that I finish it and start talking about something else and start talking about something else. So basically, that's how the margins work. Margin is only the money that the broker is giving you to purchase more positions, right? Or to have bigger purchases, if I can rightly put it, to have bigger purchases. Please post your comments and questions in the comment sections. So I want to wind up this thing called leverage. I've said that leverage is the money that the broker is giving you to hold the trades or to purchase bigger positions in the trade. So if your leverage, let's say, is one is to let's say is 100 to 1. So this means that in every trade that you are holding, let's say you have a trade that has a lot size of 0.01. Those are a thousand units. So in that trade, remember I've said that the broker will give you $100 in every dollar that you deposit in that trade. The broker will give you $100 in every dollar that you deposit in that trade. And when I say that we'll give you $100, don't get confused and assume that the broker has given you only that $1, and that is all. No. Remember, a leverage of 100 is to 1. This means that the broker has given you $100,000, right? This means that the broker has given you $100,000. Okay, so you are the one who knows what you'll do with that $100,000. But remember, guys, I said earlier that you cannot lose even 1 shilling of broker's money. You cannot lose any 1 coin of broker's money, because as you get into the drawdown, as you get into the drawdown, what will happen is that broker will automatically deduct that loss from your initial deposit. If you are in a drawdown or if you are in a loss of 20%, if you are in a drawdown of 20%, or you have lost 20% in that trade, the system will deduct that 20% from your initial deposit, so that you don't lose any shilling from broker's money, right? But if you are in a profit, if you are in a profit of 20%, the broker will also not touch even a shilling from that 20% profit, right? That 20% profit will get into your account directly, right? So broker will just take their money that they have borrowed you, then they close your trade. Suppose you want to leave that trade, they only take back their money that they have borrowed you, then they close for you the trade, or you close the trade. See, don't get confused when I say they close the trade. You close the trade, because when you close the trade, guys, you are the one who will be instructing the broker to close for you that trade, right? So I think things to do with the leverage I've explained. Let me go to lot sizes so that this concept is understood in a perfect way. So the lot sizes, I've said that we have three types of lot sizes that we normally use. The first lot size, guys, lot sizes are these figures that you are seeing here. These figures here. This is 0.01. We have more lot sizes, right? As you see here, we have 0.6, 0.7, 0.8, 0.91, 0.5, 0.4, 0.3, as we go along. So let me explain this thing, this concept in a simple way. When you see 0.01, this means that you are holding you are holding a micro lot account. A micro lot account is an account that you are trading 1,000 units, right? Or you are trading $1,000, right? And I've said that the minimum units you can trade in any trading market, most markets they will allow you to trade a 0.01 lot size, which is 1,000 units. Then after 1,000 units, we have 10,000 units. Now 10,000 units is a lot that is figured with the 0.1, right? 0.1 is a thousand units. So if you are trading an account of 0.1, this means that you are holding an account that has what? Has $10,000 units. You see, you are trading an account with an amount of $10,000, right? So guys, that is what normally happen in the trading spaces, then from 1,000 we have lot one. Sorry, we have one lot. One lot means you are holding an account which has 100,000 units. So if you are purchasing assets that are worth 100,000 units, you are holding an account called a standard lot account, right? You are holding a standard lot account. That is it. So as we move on, as you can see how these concepts are interrelating, or how these concepts are relating. You have moved from leverage, you are now on the lot sizes. You have 0.01 lot size, which is an account size of 1,000 USD. 1,000 USD. Then we have 0.1 0.1 is an account of 10,000 units, or 10,000 US dollars. Then you have an account of one, an account of one lot, an account of one lot. An account of one lot is an account that is having 100,000 USD. That is how those lot sizes work. We start from 0.01 lot size, we go to 0.1 lot size, we go to 1. We start from 0.01 lot size, we go to 0.1 lot size, then we go to 1 1 lot size. And each lot size represents the amount of units you are doing what? You are holding in that trade, right? So if you are having the broker's money, which is your leverage, you'll have to divide your leverage with the lot size that you are holding, or with the unit that you are holding. So let's say that you are having what? You are having a lot size account, a one lot size account. Let me try to do this thing practically, right? Let's say you're having a lot size, a one lot size account. So what will normally happen, or let us not go there now. I'll explain to you that concept later. But that's how leverage and lot size work. You can post your comments or your question in the comment section. All right. So what other thing do I have to explain? The position sizing. The position sizing. This is simply the position that you want to purchase, right? Let's say you want to purchase assets that are worth $1,000, right? So your position size here is $1,000. Okay, your position size is $1,000, and in a position of $1,000, guys, you are losing. You are making or losing 10 cents dollar per pip, right? 10 cents dollar per pip. Let me explain things about pips. Let me pick here a what? Uh, as an exchange rate. Let me pick here an exchange rate. So let's say you are a trader who got into this market at this area because you saw that this is guys are what? Sorry, first let me do the analysis, then I explain to you this concept. Let's say you did your analysis and you found a support level. You found a support level here, which is turning into a resistance, right? You found a support level which is turning into a resistance. Then below here, down here, you see something we call a double bottom. You see a double bottom here. You see a double bottom. I'll explain these candlestick patterns. I'll explain these candlestick patterns and chart patterns in another tutorial, but that's how traders uh, identify their areas of value. For you to identify your area of value as a trader, you need to spot an area that you are having the confidence that that area has some value that you will do it, you will gain when you execute that trade. So we normally have some areas of value that we spot. In the most cases, we have candlestick patterns we call engulfing candlesticks, and we have a bearish engulfing candles and the bullish engulfing candle. So this candle is a bullish engulfing candle because an engulfing candle should have an opposite color to the previous candle. So you can see that this is a red color, this is a green color. So this is an engulfing bullish candle. So like when we normally identify a double bottom by doing something called a termination zone. So this is my termination zone because a double bottom is a candles that are forming something like a circle like this. So let me just go very fast. I'll answer your questions in the comment section. Please, if you have a question, post it there. So I can enter into this trade because I've seen this. This is engulfing bullish candle. So where will be my entry? My entry will be here. My entry will be here, right? My entry will be here. And where will be my stop loss in this trade? My stop loss will be somewhere below this sorry guys, sorry, will be somewhere. First of all, let me mark this area very well so that you can understand it in a way that is making you is making you is making you stay with me. So guys, this is my support. This is my support level. This is my support level or support area. Yeah, because this market got here and the market dropped up to this area, then it got a bounce up, a pullback. That is, it got a pullback. Even here we had a support. Then the market was supported here, then it got a bounce up, right? So the market has gotten into this area again at this place. So there's some kind of bounce up. So this market is bouncing up again. And when I go to the lower time frame, guys, you remember when I was talking about top-down analysis, you start from the higher time frame to the lower time frame. So when you go to when I go to my lower time frame, which is now a weekly time frame, after having after the market bumping into my support area, I'll have to look for some areas of value that I can now purchase. So I can go now to the weekly time frame. So as I've said that this is my support area. So I'll get in here. After I've seen this double bottom, right? After I've seen this double bottom, then I have an engulfing candlestick. I have a bullish engulfing candlestick. So I'll get in there, then I do my what? I do my buy. I click my buy. So I'll set my price. I will set my price. So this could be my entry. 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 So my entry could be 1,803 point 63. 1,803.63. So if that was my entry, where could I have set my stop loss? My stop loss could come slightly lower my, or could come slightly below my support level, right? This is my support level, guys, and as you can see that these are around 78,424 points. When you talk now in terms of pips, these are 784.3 pips. So in a trade that you are trading 1,000 units, in a trade that you are trading 1,000 units, you make or you lose 10 cents per pip. You make or you lose 10 cents per pip. So guys, if I could have been wrong in this trade-off, or if this analysis could be invalidated, this means that if you take 10 cents, that is 0.1 multiplied by 784.27, the figure you get there, those are the amount of dollars that I could have lost in this trade, right? Those are the amount of dollars that I could have lost in that trade. And if I suppose I was holding an account of 0.1 lot, those are 10,000 units. Those are 10,000 units. So in those 10,000 units, that means that I could be making or losing $1 per pip, right? $1 per pip. So here it could have taken 784.27. You multiply by 1. Then you can get the amount of dollars that I could have lost in that trade. But if I was holding an account of let's say one lot, right? An account of let's say one lot, right? In an account of one lot, I could have made or lost $10 per pip. So if you take 784.27 multiplied by 10, you can see the amount of dollars that I could have lost if I was in that trade and lost in that trade, right? I think, guys, this concept is now sinking, right? So let us go to the profit side. So if maybe, let's say I was in the profit in this trade, guys, my stop loss could be at 1,019.41 US dollars, right? My stop loss could be at here in that trade. My stop loss was to be here at which at this place where the price was 1,019.42. So suppose I got into this trade, then I made the profit. Suppose I got into this trade and made the profit. What could be my profit, and where could I have set my target? If my stop loss was here, where could I have set my target? Guys, your target, guys, below here you are seeing something written here as ATR. ATR simply means average true range. Average true range is just a collection of 14 candles. Then you divide the pips moved in that period of where that period whereby those 15 candles were formed, right? Then average figure that you get, average figure that you get in terms of pips, those are the ATR or the average true range. Like here you are seeing 230.92. 0.92. Okay, so right now that is where our ATR is. That is where our ATR is. I've set this ATR. Guys, ATR is just an indicator. It's just an indicator that we normally use when you are trading the market. Like for example, I've been telling you that I could have set my stop loss down here. Let me go back. Let me go back a bit. I say that I could have set my stop loss. That was my entry. Then I could have set my stop loss down below. Just a minute. Just a minute. I could have set my stop loss somewhere here, right? So what could have happened in this trade? Suppose I didn't want to be stopped out, or I didn't want to be wicked out early in the trade. I could have added. What? I could have added. I could have added 230, 230, 231 to this stop loss. This stop loss. So I could have calculated the pips from here up to here. So this is 900, 990 pips plus 230 plus 231 pips. Then the figure that I could have got, I think it is around around 13 that 1,300. So my stop loss could be around 13, 1,000, 1,000, 1,300. So guys, this is where my stop loss could have been, so that I avoid it to be stopped out early in this trade. That's how we use these indicators, guys. Because why am I seeing why are we using a candle? Why are we using an ATR indicator? An ATR indicator simply allows us to know the volatility of the market during the period of candlestick formation. That period of candlestick formation. Guys, please don't get confused. Post your questions in the comment section. So an ATR is only allowing us to discover the volatility. The volatility, right? It only allowing us to discover the volatility. So if you know the volatility of the market, so that volatility will will allow you to have a room for you to know where you can put your stop loss. I will explain more about volatilities in the next video, but just understand from that explanation that ATR indicator is simply an average an average price movement uh, out of 14 candles, right? So let me go to the target explanation. Let me explain about the target, right? So if your target is here, if your stop loss is here, then your your if your stop loss is here, guys, then your target should be two times your ATR, two times your ATR. So you take what? You take 1,000. This was 1,000, 1,300, 1,323.46 times 2. So your target could be around 2,646. 2,646. 2,646. 646, right? Guys, this is where your target could have been in that trade, right? Then after that, you do what? You click buy, right? You click buy. Remember, guys, in a trading market, we are doing things we call price speculations, right? We are just speculating around prices, guys. And I've explained in most of my videos that in forex trading is just we are just doing what? Speculating prices, right? So this is where my target could have been. So what else do I have to explain? I think I've explained about the lot sizes. I've now explained the position sizes. I've explained the leverage. So that is the magic, guys, behind the forex trading stuff, right? So I think you can ask me questions if you have them. These lot sizes you can change them as you wish. These lot sizes you can change them. You can change them as you wish. You can start with even with the 0.01, 0.01. You set it, then you just change you adjust them as you want, or you can use a 0.1 lot, 0.1 lot size. I think when I say 0.01 lot, 0.1 lot, 0. I mean 0.01 lot, 0.1 lot, and 1 lot, guys, up to now you understand what I'm talking about, right? You'll forgive me, guys, I've been having some noises in the background, but you just grasp the concepts and use them to give you value. Use them to give you some value, right? So even these lines that I'm drawing right here, these lines, these are just trend lines that are giving me the direction, of the market, right? These are just like trend lines that are giving me the direction, of the market, or how the price is moving, or how the price is moving, or how the price is moving. Guys, I've decided to do this video on using MT5 and an Android phone because some of my students were telling me that they don't have the computers to do classes or to start classes, and I told them you can still use your Android phone to do what? To study forex trading or study any type of trade that you want, right? So guys, as you see on this side, on my right, we have these figures here. These figures, they simply do what? They simply show us the prices of these two commodities, which is Ethereum versus US dollar, right? Like if you see like a figure like 2,300.15, this means that this price was on which day? This price was on each day when I pick it. Let's say, let me pick this candle. Let me pick this candle. Let me pick this candle. This candle here. So you can see that on Sunday 18th January 2026, the price of Ethereum versus US dollar was 3,367.38. That was the price. So this was the exchange rate in that market. For you to acquire one Ethereum on that day, you had to give someone 3,367.38, right? That was the price on that day. So these are simply the exchange rates, guys. These are just the exchange rates, and you can post your questions in the comment sections, right? I think I've talked about most of the things that are important. These are just time frame. 1 minute time frame, 5 minutes time frame, 15 minutes time frame, 30 minutes time frame, 1 hour time frame, 4 hour time frame, 1 day time frame, and 1 week time frame. So this time frame I explained them earlier that they normally do what? They just represent the price movement of that asset in a specific period of time. Let's say we are in a 1 day time frame, right? So this means that it took 1 day. It took 1 day for this bullish green candle to do what? To form, right? It took 1 day for this candle to form, right? Let us go to another time frame, weekly time frame. This means that it took 1 week. It took 1 week for this candle to form. Guys, let us meet in another video, and you can post your comments in the comment section. Right? I will explain more videos. Guys, bye. Finally, let me just do something here. Pick a candle. Let me do another video, guys, so that we can meet in that one in the next video, so and explain more concepts, and explain more concepts.